Welcome to the Deep Dive. Today, we're really digging into some fascinating source material. It's focused on something absolutely essential for, well, pretty much any business owner, but maybe especially if you're in the rental game. We're talking about managing cash flow.
That's right. The material we've got here, it's an excerpt that it really zooms in on building a rental business, specifically looking at smart financing strategies. It kind of follows the story of one company and how they navigated those, tricky early stages.
Yeah, and our mission for this deep dive is pretty straightforward, but honestly, super important. We want to unpack these specific strategies. We want to understand why cash flow is so often called like the lifeblood of the rental industry.
Mm-hmm.
And we'll follow this one particular business's path, see how they actually use this focus on cash flow to, well, scale pretty dramatically.
Yeah, you're going to hear about tackling that initial capital crunch, looking at different ways to finance your assets. And hopefully you'll get some really practical takeaways you can sort of immediately think about applying yourself.
Okay, let's get into it then. So right at the start, the source material throws down this big statement. Cash flow is the lifeblood of a rental business. Why such dramatic language? Isn't profit the main thing?
That distinction, it's actually one of the most critical points the source makes. Profit tells you if you're making more than you spend over a period. It's like the ultimate scorecard.
Right. Makes sense.
But cash flow, that's different. That's about the actual money you have available right now, today, this week.
Money in the bank.
The liquid cash, what you can actually spend.
Exactly. You could, believe it or not, be technically profitable, have loads of valuable assets on paper, but if the cash isn't physically coming in when you need it, to pay salaries, cover repairs, pay your suppliers, you're in deep trouble.
So a profitable business could actually go under. Absolutely. It happens. Poor cash flow can kill a profitable business. And the source mentions this applies across the board, whether you're renting out huge boom lifts, scissor lifts, or, everyday items on platforms like Rent Anything Store. The principle's the same. Cash stops, everything stops.
Wow. Okay. And that leads straight into the first big hurdle the source talks about, which sounds familiar. That classic startup problem. You've got interested customers. The demand is clearly there.
Yeah.
But you just don't have the pile of cash needed to buy all the expensive gear they actually want to rent from you.
It's the constant catch-22 in rentals, isn't it? Need this stuff to make money, need money to buy this stuff. The business in this source material, they ran smack into this when they started their lift equipment company, became a JLG dealer, saw huge demand for certain lifts.
But couldn't afford them.
Exactly. Didn't have the, millions sitting around to just buy them outright.
So, okay, they're facing that.
Yeah.
High demand, no cash. What was their first move? How did they even get the ball rolling?
Right. This is where their first strategy kicks in. It's called sub-renting.
Sub-renting. Okay, and the source explains that as basically renting equipment from another rental company, maybe at a discount or wholesale rate.
Mm-hmm.
And then you turn around and re-rent that same piece of equipment to your customer, but at your own higher price.
Precisely. And this business, they leaned on this hard at the start. The source says they sub-rented the popular list's own lifts, scissor lifts, for about a full year. They were essentially acting as rental brokers.
That sounds actually really clever for a low capital start. What were the big advantages they got from doing it that way, according to the source?
Well, the obvious one is the tiny initial investment, right?
Yeah.
They sidestepped needing massive capital for the lifts themselves. But, and this is crucial, it let them start generating cash flow almost immediately.
Making a margin without the ownership headache?
Exactly. Making a margin on each rental without carrying debt payments or worrying about depreciation just yet.
And here's something I found really smart. The source says it acted as amazing market testing.
Yes. Huge point. By seeing which sub-rented machines were always out, always in demand, they got real hard data on which specific pieces of equipment were the most profitable ones to eventually own.
So they weren't guessing later on.
No guesswork. They proved the demand, identified the winners before sinking serious money into buying. And that cash flow they generated during that whole sub-renting phase, absolutely vital. It built up their reserves, sure, but it also demonstrated a reliable revenue stream. That's what let them even think about the next step, owning their own fleet.
Which brings us nicely to that transition.
Mm-hmm.
They've proven the model. They've got some cash coming in. The focus shifts. And here's a point the source really hammers home. They realized paying cash for big equipment early on could actually hurt their cash flow. Now, that feels backwards, doesn't it? Isn't paying cash always best?
It feels like it should be, right? Cash is king. Avoid debt. But Think about it. If you tie up huge chunks of your limited startup cash in one or two massive assets.
Even if you own them outright.
Right. Even if you own them debt-free, that cash is now locked up. It's not available for all the other things a growing business desperately needs.
Like payroll, marketing, smaller tools, repairs, just
Right.
operating cash.
Exactly. If you starve those areas because all your cash is tied up in one big lift, you can't operate effectively. You can't grow. So they made a conscious pivot to their second key strategy, really leaning into leasing.
Okay, leasing. Let's unpack that. Why was leasing the big answer for them once they were ready to start acquiring your own gear?
Well, leasing basically let them get their hands on those high-value assets, the big lifts they knew were in demand, but without the massive upfront cost or the crippling monthly payments of a traditional loan, especially compared to trying to pay cash.
And the source mentions a specific tactic here, opting for long-term leases that include something called a residual value. Can you break that down? What does that mean in practice?
Sure. So a lease with a residual value. It means your payments over the lease term, say 5 or 7 years, they don't actually pay off the entire value of the equipment. There's a chunk left over at the end. That's the residual.
Okay.
The big advantage is because you're only financing a portion of the asset's cost during the lease term, plus interest, of course, your monthly payments are significantly lower.
Ah, I see. You're not hammering down the principal quite so aggressively month to month, so less cash goes out the door each time?
Precisely. And the source highlights the key benefits this gave them. Number 1, low monthly payments, obviously, spreading the cost. Number 2, and this is the big one, it preserved their cash flow. That freed up cash could go into operations, marketing, hiring people, buying more smaller inventory items.
Makes sense. More breathing room.
Yeah, exactly. And third, it offered flexibility. They could structure lease terms to roughly match the expected useful working life of the equipment.
And this connects right into their third strategy, which I have to say really challenges how a lot of people think about debt. It's about prioritizing long-term financing. The source specifically warns against just focusing on the absolute shortest path to paying something off.
Yeah, this is probably the most counterintuitive piece of advice in the whole thing. The argument is, for certain types of assets, especially ones that last a long time and hold their value reasonably well, taking a longer financing term, even if it means you pay more total interest over the entire period, can actually be the smarter strategic move for a business focused on growth.
Wait, so paying more interest could be a better business decision. How does that work?
It sounds crazy, but yes, purely from a cash flow management perspective, that's the argument. And they use a great example in the source, financing a Bobcat.
Okay, a Bobcat loader. Rugged machine. What's the typical lifespan on something like that?
Oh, the source reckons 20 years, maybe even more. It's a serious long-haul asset. So the example they give is financing one with, say, a 7-year lease that has a 25% residual value tagged onto the end.
Right, so that 25% isn't paid off during the 7 years, which, as they calculate it, kind of effectively stretches the total financing out closer to 9 or 10 years if you factor in dealing with that residual piece later.
Exactly. And the absolute key point here is the impact on cash flow. With that longer-term structure, the monthly payment is way, way lower than if you tried to pay it off aggressively over, say, 3 or 5 years.
Got it.
Yes, over that full decade, you'll pay more in total interest, no doubt. But those significantly lower monthly payments, they ensure you have consistent positive cash flow coming out of that asset each month, and that cash flow is what keeps the lights on, lets you operate smoothly day to day, and, really importantly, makes it easier to borrow more money later when you need it.
Okay, that connection healthy cash flow makes it easier to borrow. That's huge. How does keeping your monthly payments lower make you look better to, say, a bank or a lender?
Well, lenders are always assessing risk, right? They look at your overall financial health. Things like your debt-to-equity ratio, sure, but fundamentally, they want to see your ability to consistently make your payments.
Okay.
So if you've structured your financing with these manageable, predictable, lower monthly payments, you're demonstrating month after month that your business generates enough profit to comfortably cover its debts without, straining everything else.
So lower monthly payments signal stability?
Right.
Less risk for the lender.
Exactly right. And the source spells out the knock-on effects, the benefits. Number 1, it improves your borrowing capacity, makes it easier to get that next loan or line of credit when you want to expand. Number 2, it frees up capital so you can reinvest profits back into the business, maybe marketing, maybe buying more inventory, upgrading the fleet.
Keeps the growth engine fueled.
Precisely. And ultimately, it allows for scalable growth. you can keep financing more assets to meet rising demand without completely draining your cash reserves every time you buy something big.
Okay, so the source pulls all this thinking together into some really practical, actionable tips for managing cash flow. If someone's listening, what were the main takeaways?
Yeah, there's a good checklist. First, if capital's tight, seriously consider starting with subrenting. Use it to test the waters, build that initial cash flow, don't rush into buying. Second, leverage leasing, especially looking at those structures with residual values to keep the monthly payments down and hold on to your cash.
And tying back to that counterintuitive point, for the right kind of assets, the long-lasting ones, prioritize long-term financing focused on those manageable payments. Don't just obsess over paying debt off super fast if it strangles your cash flow.
Absolutely. And then beyond the big financing strategies, the source stresses the importance of active management,
Sure.
monitor your cash flow constantly, know your numbers, understand your cycles using statements, forecasts, make it a regular habit.
Not just a once-a-year thing.
Definitely not. Also, build up a cash reserve, a buffer. For those unexpected repairs or slow months, it's crucial. And finally, talk to your lenders. Keep those communication lines open, build relationships.
So we've walked through these strategies. Subrenting first, then strategic leasing, then this focus on long-term financing. The big question is, did it actually, work for the business in the source material?
Oh, absolutely. It worked big time. The source really highlights their incredibly rapid growth and directly credits it to this disciplined focus on cash flow and using financing smartly.
How rapid are we talking? What kind of scale did they reach?
Get this. The source says they grew to $6 million in annual revenue within just 3 years.
Wow, for basically nothing.
Pretty much. And in that final year, they were generating nearly $1 million in profit.
That's serious growth. And what happened then?
Well, the ultimate validation, I suppose. They ended up selling the business to Hertz Equipment Rentals.
A major player. So a really significant exit.
Huge success story. And again, the source ties it right back to their approach. It reinforces that core lesson, that kind of fast but sustainable growth. It just wouldn't have happened without constantly prioritizing cash flow and being strategic, maybe even a bit unconventional, about how they finance their assets.
So the lessons learned weren't just about getting started, they carried through.
Definitely. The source kind of circles back to reinforce those key principles for the long haul. 1, always prioritize cash flow. Remember, even a profitable business can fail without it. 2, invest in quality assets, things that last a long time and hold their value. That's what makes the long-term financing strategy viable.
Right, it wouldn't work as well with stuff that wears out quickly.
Exactly. And 3, be ready to adapt your financing strategy as your business changes and grows. What worked in year 1 might not be optimal in year 5.
Now, the source also briefly mentions how modern tools, like platforms, can fit into this picture. It brings up Rent Anything Store as an example.
Yeah.
How does that connect?
Yeah, platforms like Rent Anything Store, they can support this cash flow focus in a few ways, mostly by helping you streamline your operations and boost your revenue, both of which directly feed into healthier cash flow.
How so?
Well, the source points to benefits like increased visibility, getting your equipment listed where more potential customers can easily find it, often without you having to spend a fortune on separate marketing. More eyeballs, more potential rentals.
A wider reach. Makes sense. And it also mentions flexible pricing tools.
Right. Being able to adjust your pricing based on demand, maybe charge a premium during peak season, that helps you maximize the cash coming in. And then there are the efficiency gains, good management tools for tracking your rentals, handling payments, communicating with customers. All that stuff saves you time and administrative hassle, which indirectly helps your bottom line and cash flow.
So, okay, pulling this all together, this deep dive really hammers home that cash flow isn't just, one important number for a rental business. It sounds like it's the absolute foundation everything else is built on.
Yeah, I think that's fair to say. Especially in those early and growth stages, it's arguably more fundamental than just trying to own everything outright as fast as possible or paying down debt at lightning speed if it kills your operating cash.
We've sort of followed the journey described in the source, starting lean, almost risk-free with subrenting, then using leasing really strategically to get the big assets but keep payments manageable.
Right.
And understanding that surprising power of long-term financing, especially for those valuable, long-lived pieces of equipment.
And seeing how that whole strategic financing approach fuels healthy cash flow, which in turn is what allows you to scale up, reinvest in the business, and ultimately build real significant value.
And remembering that leveraging the right tools and platforms can definitely help support those strategies along the way.
So here's where it gets really interesting, I think.
Yep.
If you think about that core idea, that kind of counterintuitive principle we kept coming back to from the source.
The long-term financing one.
Yeah, that for certain assets that generate revenue over a really long time, intentionally choosing longer financing terms, even accepting you'll pay more total interest, might actually be the superior strategy for overall business growth compared to just aggressively paying down debt as fast as humanly possible.
Okay. That definitely challenges conventional wisdom.
It does, and it raises a really interesting question for you, the listener, to chew on. How far does that principle extend? Does it only apply to rental equipment like lifts and bobcats? Or could that same logic prioritizing cash flow for growth via longer financing terms potentially hold true for other types of long-term value-holding assets in completely different kinds of businesses? Something to think about.